Welcome to ZICA Academy YouTube channel. In this lecture, I want to examine pricing decision. This is my second video on the topic. In this second video, I'll be examining the cost-based pricing decision. If you are coming across my lecture for the first time, please make sure you like the video and also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. In this second video, I will examine the meaning of cost-based pricing decision, classification of pricing decision based on the cost. Then I will also solve standard examination questions from ACCA past questions. The same question can as well be obtained from Workout Performance Management by Ade Omoleyiwa. Cost-based pricing decision. Under this method, the cost of the product forms the basis for setting its price. The cost of the product serves as the basis for setting the price of that product. So that means if you want to set the price of the product, price will be cost of the product plus percentage markup. You add markup to the cost. So this will give you the price of the product. Price. Then the price of the product on the basis of cost-based method will be categorized into two. So we have cost-based pricing. Cost-based pricing will be divided into two. We have marginal cost plus marginal cost plus and the total or full cost plus full cost plus. Under the marginal cost, you know the marginal costs are the variable costs. So when you determine the variable cost of the product, then you add a percentage markup to the variable cost. That will give you the price on the basis of marginal cost plus. Number one, we have marginal cost plus. Remember, marginal costs are the variable costs. Variable cost of production. You consider those one that relates to production. Variable cost. Then you add markup to the marginal cost. So if you have the variable cost, you mark it up. You apply markup on the variable cost, you get the price of the product. That is marginal cost plus. The second method is full cost plus. Full cost plus. By full cost, it means you consider the variable cost, variable cost of production plus fixed production cost then you have the full cost. That is, you add the variable cost and the fixed cost together, you get the full cost of the product, then you mark it up. The markup represents the profit element. Then you get the price of the product. That is full cost plus. So the features of marginal cost plus. Price are set too low. One of the major features of the marginal cost plus, the price may be too low. It is useful in short-term decision. This method is useful in short-term decision. The second method, all costs are incorporated into pricing decision. All costs are considered under the full cost plus. Then it ensures profits are made, provided the target volume are achieved. This method ensures that profits are made, provided the target volume are achieved. Then the price may not be realistic with what customers are willing to pay, because absorption of these overheads will make the price to be too high. So these are the features of full cost plus. I want to take question as work example. Keep watching. Hammer is a large garden equipment supplier with retail store throughout the country. Many of the products it sells are bought in from outside suppliers, but some are currently manufactured by Hammer's own manufacturing division. Nay, the price is a transfer price that Nay charges to the retail stores are set by head office and have been the subject of some discussion. The current policy is for NAE to calculate the total variable cost of production and delivery and add 30% for profit. NAE argues that all costs should be taken into consideration, offering to reduce the markup on cost to 10% in this case. The retail stores are unhappy with the current pricing policy, arguing that it results in prices that are often higher than comparable products available on the market. May has provided the following information to enable price comparison to be made of the two possible pricing policies for one of its products, garden shares. Still, the shares have 0.4 kg of high quality steel in the final product. The manufacturing process loses 5% of all steel put in. Steel costs 400,000 naira per ton. 1 ton equal to 1,000 kg. Other materials. Other materials are bought in and have a list price of 300 naira per kg. Although Hammer secures a 10% volume discount on all purchases. The shares require 0.1 kg of these materials. The labor time to produce shares is 0.25 hour per unit and labor cost 1,000 naira per hour. Variable overheads are absorbed at the rate of 150% of labor rates, and fixed overheads are 80% of the variable overheads. Delivery is made by an outsourced distributor that charges NAE 50 naira per garden share for delivery required. Calculate the price that NAE would charge for the garden shares under the existing policy of variable cost plus 30%. B. Calculate the increase or decrease in price if the pricing policy switched to total cost plus 10%. And you are to calculate the price that NAE will charge for the garden shares under the existing policy of variable cost plus 30%. Now you have to determine the variable cost. Now let's have the solution. A. What will be the price under existing policy? Remember, the existing policy is variable cost plus 30%. Variable cost policy. So, if the shares have 0.4 kg of high quality steel in the final product, the manufacturing process loses 0.5%. Loses 5%. If 5% is lost in the production process, that 5% is the normal loss of all steel put in steel, costing 400,000 per ton. Now, let's calculate the value of steel that will be required for production. Steel 0.4 kg is required. and you are given the cost to be 400,000 per ton, and you were told a ton is 1,000 kg. So you divide it in order to convert it to kg, to price per kg, not price per ton. So this will give you 400,000 divided by 1,000. That gives us 400. 400 times 0.4. That gives us 160. 160. Then we have a normal loss. Normal loss of 5%. If 5% is normal loss, that means the output achieved, this 160 is equivalent to 95%. So you have 5 over 95 if 5% is lost. So we have 5 over 95 times 160. Because after the loss, if input is 100, if input is 100 kg and a loss of 5% is recorded, then that means the output will be equivalent to 95%. So that is what I mean by 95%, that this one is equivalent of 95%, since 5% was lost in the production process. So what was used will be equivalent to 95%. So that's why we had this to be 95. So 5 over 95 times 160. That gives us 8, approximately equal to 8. So if you add it, you have it to be 168. Other materials. Other materials are bought in and have a list price of 300 per kg. Although Hammer secures a 10% volume discount on all purchases, the shares require 0.1 kg of this material. This is what is required. So, and it is 0.1 kg is required, and the price is 300. So, other materials, 0.1 kg is required. The price is 300 naira. And you were told a discount of 10%. Hammer secured a 10% volume discount. If you remove discount, that means the amount that will be paid will be equivalent to 90% times 90%. That is, calculate this times this, whatever you have, calculate 10% of it and subtract it. Or just subtract 10 from 100, you'll be left with 90%. Calculate 90% or whatever you have. 0.1 times 300 times 90%, that gives us 27 naira. The labor time to produce shares is 0.25 hour per unit, and labor cost 1,000 naira per hour. So for labor now, labor time is 0.25 hour per unit, and the cost is 1,000 naira per hour. Back to the question. Variable overheads. So this is for variable overheads. So what is 0.25 of 1,000? 0.25 times 1,000. That gives us 250. So that means the cost of labor is 250 naira. Back to the question. Variable overhead. Variable overheads are absorbed at the rate of 150% of labor rate. The labor rate is 1,000 naira. So 150% of 1,000 naira. So for variable overheads now, variable overheads, the same hours for labor is used for variable overheads. 0.25 hours times, so we're told it is 150% of labor rate. 150% of labor rate. Labor rate is 1,000. 150% of 1,000, that will be 1,500. 150% of 1,000, that is 1,500. Then 0.25 times 1,500 times 0.25, that gives us 375. Alternatively, you can calculate 150% or 250. Just calculate 150% or 250. That gives us 375. You will get the same answer by calculating 150% or 250, since this is the labor rate. Back to the question. So we have our fixed overheads are 80% of variable overheads. So remember, we are under the variable cost policy. So the fixed overhead will be excluded. So delivery is made by an outsourced distributor that charges me 15 naira per garden shares for delivery. So we have delivery cost, delivery, that is 15 naira. So what will be the total variable cost? That is total marginal cost or variable cost, total variable cost. So now let's sum it up. 168 plus 27 plus 250 plus 375 plus 50. So we have 870. 870. So we mark it up. So markup. What is the markup now? In the requirement A, you were told calculate the price that NAY will charge for the garden shares under the existing policy of variable cost plus 30%. So the markup is 30%. Let's calculate 30% of 870. 30% of 870, that gives us 261. So if you add 261 to 870, so we have 1,131. That is the price that will be charged. That is the price of the product. So the requirement B, you have to calculate the increase or decrease in price if the pricing policy switch to total cost plus 10%. So the pricing policy is now total cost plus 10%. Remember, the total cost will comprises both the variable cost. We have the variable cost as calculated above. I will lead that variable cost from our first solution, total marginal cost or variable cost. We have it to be 870. Remember, marginal cost is the same as variable cost. Variable cost. So we consider the fixed cost this time around, since it is total cost that is required. How much is the fixed cost? Back to the question. And fixed overheads are 80% of variable overheads. Fixed overheads is 80% of variable overheads. 80% of variable overheads. How much is the variable overheads? We have variable overheads. As calculated, we got 375. Now calculate 80% of 375 naira. 80% of 375, that gives us 300. That means we have the fixed overhead that will be absorbed to be 300. 300 plus 870. Then we have the full cost to be 1,170. This is the full cost. Full cost or total cost. Then we equally mark it up. What will be the markup this time around? Back to the question. Calculate the increase or decrease in price if the pricing policy switch to total cost plus 10%. So the markup is 10%. Now let's calculate 10% of the total cost of 1,170. 10% of 1,170. That gives us 117. So we have the markup. The markup represents the profit element. So if you add it to the full cost of 1,170, so you have the price to be 1,287. So this is the price under this policy. Now, if you compare this price with the existing price, you discover that this price is greater than this. And you have to calculate the increase or decrease. That means since the price under this new policy is greater than the price under the existing policy, that means you have an increase in price. And how much is that increase? Increase now will be 1,287 minus 1,131. You have the increase of 156 naira. So you have the increase of 156 naira. This marks the end of the solution to the question. Please drop the love emoji and also share the video with others. Thanks for watching ZICA.